Okay, let's dive right into this explainer. We hear a ton of surface-level hype about TSMC's Q2 2026 financials, record-breaking this, AI dominance that, but today, we're looking past all that noise. We're going to uncover the hidden costs and the very real physical execution risks behind these massive numbers. Let's see what it actually takes to fuel the future.
But hey, before we correct the record, we absolutely have to acknowledge the reality on the ground, right? TSMC is without a doubt the central motor of this whole AI revolution. The sheer scale of their operation is breathtaking. So what is actually driving these massive Q2 numbers?
Well, check this out. A staggering 66% of their revenue is now driven exclusively by high-performance computing and AI. We're talking about the massive server clusters doing the heavy lifting for artificial intelligence. This isn't just a side hustle anymore, folks. It is the absolute core of their business model, completely overshadowing their traditional segments.
And if you're wondering where all that cash is coming from, a whopping 78% of that massive revenue flows straight out of North America. That firmly cements their geographical dominance. Basically, U.S. tech giants are completely funding this operation, tying TSMC's ongoing success directly to North American demand.
Now, looking at the silicon itself, the story is just as wild. Advanced nodes of 7 nanometer and below, those microscopic switches inside a chip, make up a massive 77% of total wafer revenue. And get this, the absolute bleeding edge 2 nanometer node is already capturing 3% of the pie. The market's appetite for these incredibly packed chips is literally insatiable.
Add in a confirmed, incredibly healthy gross margin of 67.7%, and wow, the financial picture looks nearly flawless. But here's the catch. The CoWoS, advanced packaging, where they stack these chips together like tiny 3D puzzle pieces, is still a massive bottleneck. The pressure is actually so high that CEO C.C. Wei surprisingly praised Intel's competing EMIB technology. I mean, that just shows you exactly how tight the packaging market really is globally.
All right, let's move into our first main section, correcting the record, claimed versus reality.
First up, top-line revenue. The claim echoing around some financial circles was $40.2 billion. But honestly, that was just the absolute upper limit of their initial guidance. The confirmed reality is $39.62 billion. Now, sure, it's slightly lower than the wildest rumors, but make no mistake, that still represents a phenomenal 36% year-over-year growth.
And when we talk about net profit, the reality is just as impressive. We're looking at a confirmed 706.6 billion new Taiwan dollars, which translates to roughly 22 billion US dollars. That solidifies a massive 77.4% year-over-year growth rate. The sheer profitability of their advanced node monopoly is just undeniable.
Then there's the massive Arizona investment. There have been all these chaotic, completely unverified estimates claiming a $265 billion total. Let's just clear that up right now. The official, confirmed number from TSMC is $165 billion, and that's for 6 fabs and 2 packaging facilities. It's a colossal investment, for sure, but precision really matters when we're evaluating capital expenditure at this scale.
Okay, moving on to our next section, beneath the surface, the ecosystem price pressure. So, while TSMC is undoubtedly profiting at historic levels, we really have to stop and ask a critical question here. Who is actually absorbing the cost of all this relentless innovation? Building the hardware of the future isn't cheap. And eventually the bill always comes due. And that brings us to this incredibly striking number, $30,000. A single 2 nanometer silicon wafer, the large disk that gets sliced up into individual chips, now costs over 30 grand. To put that into perspective, that is a massive 50% jump compared to their previous 3 nanometer wafers. The cost of living on the bleeding edge of tech is literally skyrocketing. And the thing is, this isn't just some one-off hike to cover new research and development. TSMC is aggressively raising prices across the board for the 4th consecutive year. Depending on the node, they're demanding 3 to 10% increases. They have the monopoly on the world's best chips, and they are unapologetically flexing that pricing power.
So what does this actually mean for us? Well, it creates severe downstream pressure across the whole tech ecosystem. A company like NVIDIA, sure, they can absorb this cost thanks to their super wide margins. But consumer-facing companies like Apple and Qualcomm, they are forced to pass those costs downstream. Ultimately, this leads straight to severe consumer inflation on everyday devices. Yep, in the end, it's the consumers paying for those $30,000 wafers.
Next up, let's explore our third section, the deep
Arizona execution risks.
The logistical nightmare they're navigating out in the U.S. desert is just immense. I mean, they have to secure massive amounts of water, requiring a totally dedicated industrial water reclamation plant by 2028. On top of that, they're battling active visa delays, struggling to bring over highly trained Taiwanese engineers. Then you add in long-term electricity constraints, and perhaps the biggest kicker, production in Arizona is estimated to be 50% more expensive than manufacturing back home in Taiwan.
All these logistical headaches seriously threaten an already incredibly tight expansion timeline. Phase 2 facilities are expected to come online between 2027 and 2028, with phases 3 through 5 stretching all the way out to 2030. Any single slip-up, whether it's water, power, or personnel, directly threatens this precarious schedule. Actually, TSMC's CEO, C.C. Wei, hit the nail on the head regarding these exact friction points. He recently said choosing tech and developing it isn't like buying milk from 7-Eleven. It's a pretty funny, grounded quote, but make no mistake, it serves as a stark, serious warning to the market about the immense physical realities of advanced semiconductor manufacturing.
All right, let's wrap this up with our final section, the balanced bull thesis. So here's our main takeaway from all this data. TSMC is undeniably the central motor of the AI revolution. We know that. But it is a motor running on increasingly expensive fuel. From those $30,000 wafers to the massive 50% premium on Arizona production, TSMC is essentially being forced to squeeze its own clients' margins just to maintain its historic dominance. Which leaves us with this final, provocative thought. As clients gasp under these relentlessly rising costs, could this friction finally open a door? Will this extreme price pressure create a much-needed opening for alternative, cheaper, lower-power hardware models to step in and disrupt the whole market? It's the ultimate question going forward, and it really forces us to look beyond just the raw numbers. Thanks for diving into this explainer with me today, and as always, keep questioning the data.